Hi class, in this we're going to go over chapter 27, so money and banking. So this is a very important chapter. Many of your future chapter based on this one, so make sure pay careful attention. Okay, so let's get started. All right, so first let's take a look at this picture here. So is this a shell or is this money? Right, so it really depends on who you ask, right? So the answer is could be both. So it depends on who you talk to. So for centuries, people in the old ages, they used to use shell as form of money. So think about, before the days we had, US dollars, our coins, what do people do to trade? What was the currency that people used? So shell was commonly used as a form of payment, right? So that was money. So in the old days that was money, but today we just use it as a decorative, right? So let's talk about what is money. But before talk about money, let's talk about what happens if we don't have money, right? So whenever we have a system that doesn't involve money, we'll call this barter. So barter is whenever you trade good directly for another good with no money involved. That's called barter. So this works. So if you guys, anybody here would like to watch the Office, remember there was one episode where there was a company garage sale that Dwight traded all the way from a paperclip to a telescope. At the end, he traded for like magic bean. Now all those trade happened with no money involved, and that's called bartering, right? So that works because something called double coincidence of wants. Now remember at the very beginning of each trade that Dwight had to convince the other party just to trade with him to make sure the other party want what he has, right? So that's called a double coincidence of wants. So with no money, that whatever you're trading with other party, that both party here must want what the other party has to make the trade happen, and that's called a double coincidence of wants. So if you have this double coincidence of wants, then barter will work. But if you don't have it, then it just won't work anymore. That's why we need money, because money can serve as an intermediary that everybody want, right? So, by the way, so that little Dwight, paperclip thing, there's a guy who actually did it. So if you guys go to Google, go to YouTube, search for TED Talk, and then type in paperclip. So there's a guy who actually traded all the way from paperclip to a house. Now that's called bartering. There's no money involved. But that also took the guy almost 2 years of his life. So it's very inconvenient because if he has money, just go buy it. But that's no money involved. All right, so let's look at what is money. So for anything to become money, it must satisfy four functions. So first, money must be a very good medium of exchange. That means you can use money widely everywhere as a method of payment, and everybody will take it. Second, your money must be a very good store of value. That means if you're holding on to it, then your money will still be pretty good in value. And number three, your money must be a very good unit of account. That means you can use your money to match the value of something else. So, for example, let's say um, a chicken sandwich from Chick-fil-A, right? So would that be used as a unit of account? Well, sure, right? So what if I say, hey, take notes for me, and then I will pay you with 2 orders of chicken sandwich from Chick-fil-A. Now that situation, that your chicken sandwich is used as a unit of account to measure the value of something else. And lastly, your money must be a very good standard of deferred payment. That means money can be accepted to make purchase today, and they will be paid in the future, right? So that means you can borrow this, you can pay it back as a foreign payment. So those four are the four functions of money. All right, so there are two types of money. The first one is called a commodity money. So commodity money, their money by itself has its own value. So think about your gold, your silver, your diamonds. Those will be all called commodity money because their money by itself has its own value. And then also there are currencies in the world that's backed up by real commodities. So for example, US dollar was on the gold standard before 1970s. That means in the old days, literally you could have used your US dollar, go to our Federal Reserve, exchange for gold. because how much our dollar is valued is backed up, is actually fixed to the value of gold. You can change for gold, right? So that was the commodity-backed currency. But today we don't use it anymore. Today our money is backed up by the credit of our U.S. government. So your money is only as good as your U.S. government. That means if tomorrow, let's suppose, I don't know, North Korea take over, then we don't have government anymore, then your US dollar will be worthless because it's not backed by anything else. But if it's backed by gold, then it can still go exchange for gold. So that's called commodity money. Fiat money, on the other end, that's your US dollar. So fiat money has no value behind it. So fiat money is only as good as the US government. Most of the currencies in the world, most of the currencies that you know of, they are all fiat money, that there's no commodity money behind it. So most currencies in the world, they are only as good as the government behind it. Okay, so let's take a look at our US dollar. So let's see if you recognize this. Of course, the one on top, that's one you see most often. That's the recent one. The one at the bottom is actually a very, very old US dollar. But what you see, some common denominators, they all have, George Washington on a dollar bill. They all have the number 1 on dollar bill. That's how you know it's a US dollar. They all have that serial number. If you see it on the new one, that's right here, the serial number. On the old one is right here. So there's a website. It's called whereisgeorge.com. If you type the website and then type in the number, it will show you where your dollar has been to. Okay. And also on the dollar bill, it says United States of America. That's how you know this is $1. But there's one more thing on it that's very, very important. Notice right here, it says the Federal Reserve note. Right. So who is this Federal Reserve? So for Federal Reserve, every country has a central bank. So besides your Bank of America, your Wells Fargo, your Chase, those are private banks run by private companies. Central bank is run by the central government. So our federal government control this bank called the Federal Reserve Bank. Now, you and me, we cannot do any business with Federal Reserve. But Federal Reserve does have some very, very special functions that cannot be replaced by anybody else in the economy, and Federal Reserve is essential. Actually, any central bank is essential for the nation's economy. Because a couple of things the central bank does. First, the central bank will provide banking regulation for all the banks in the country. So think about your Chase, Wells Fargo, Bank of America. Who do they listen to, right? Who regulate them? Our central bank, the Federal Reserve. And second, your Federal Reserve also responsible for what is called a monetary policy. So we're going to talk more about this in the later chapters. So this is when the government step in and then use our quantity of money to control the economic outcome, right? So think about how much our money is worth, how much our interest rate is, what would impact our inflation. Those will be all coming from the monetary policy, and that monetary policy is conducted by our Federal Reserve Bank. Okay, so and lastly, Federal Reserve also define money according to its liquidity. So liquidity is just how quickly you can turn money into cash. I mean, that sounds a little odd, right? So isn't money already cash? Well, let me put it this way. So all cash are money, but doesn't mean all money are cash. So there are some money out there that is not cash, right? So let's take what they are, right? So there are also 2 types of money. They're called M1 and M2. So M1, this is something really close to cash. So the asset you can turn to cash very, very quickly. So you can quickly convert this M1 into cash. So M1, they're your actual cash. So that is money. So it includes currency, the cash. It also includes checking account in the banks. Now, if you know what checking account is, if you go to a bank, open a checking account, that means you can deposit your money in there, with your direct deposit, and also you can get your money out with no restriction. So you can write a check, you can withdraw the money, and they usually come with a debit card on the checking account. So it's a checking account, so you can turn your money in the checking account to cash very quickly. And lastly, something called a traveler check. So traveler's check, this is something very popular in the old days, especially before the days of debit card, credit card. So in the old days, it was very inconvenient for traveler to bring cash with them, because imagine if I bring a lot of cash with me and if I lost it, then I lost it, right? So there's no way to get the money back. It's not secure. But if I carry my checkbook with me, to go, let's say from Texas to California, the bank in California doesn't know how much money I have in the Bank of Texas. So more than likely, they wouldn't even be able to honor that check in California, because they don't know how much money is in the Bank of Texas, right? So bring a check is very inconvenient. Bring cash is very insecure, very risky, and that's where the traveler checks come in. So for traveler check, you can go to your local bank, purchase traveler check, and you can carry them with you, and they work just like cash. You can pay, and you can pay for it, pay using to pay for stuff. You can also spend it, deposit it, however you want to use it. It's just like cash. And then if you ever lose it, you can always call the company and they replace it for you. So it's very convenient, also very secure. But we don't use that anymore, and that's because we use more debit card and credit cards, and they work just like cash, right? So M1 is your currency, your checking account, and also traveler check. M2 is a bigger definition of money supply. So M2 has everything in M1. So M1 is part of M2. It also have your saving deposit, so your saving account in the bank. The difference between your checking and saving. By the way, guys, if you know the difference between the checking account and saving account, that means you are pretty good, or you know what, you're pretty old. Ask your parents. Most of them will tell you what the difference is between saving account and checking account. One of the major differences, for checking account, you can get your money out anytime you want. For a saving account, they tend to have different restrictions on how often or when you can get the money out. So let's say, on many of the saving accounts, they will say, hey, for the money deposit in the account, you can only make a withdrawal for, let's say, 4 times a month or 5 times a month, right? So they'll put a restriction on how often or how you can withdraw the money. And that's called a saving account. But the benefit of a saving account is that more than likely, they're going to offer you a little higher interest rate than the checking account. And then we have the money market mutual fund. So this is also a different type of saving account. And difference is your saving account tend to have a fixed floating rate, a fixed interest rate. The money market account tend to have a floating interest rate. So the interest rate on the account varies, depends on what time it is, or what different economic conditions. And lastly, something called a certificate deposit. In the bank, this is also called a CD. It stands for certificate deposit. So what it does, it's a fixed time saving account. So imagine you might have a 6 months, 1 year, 2 years, 3 years. So you promise to put your money in the CD for that fixed time. Then you cannot get your money out. And then doing that, the bank will pay you a little higher interest rate. So imagine if your saving account offer you, let's say 2%, your CD might offer you 3%, so a little higher interest rate. But if you want to get your money out early, then you might lose the interest on the money you earned, right? So that's a CD. So M1 can be turned to cash very quickly. M2 is a bigger definition of money. It includes your M1 plus your saving, money market, and CD, your certificate deposit. All right, guys, we're going to talk about this. We talked about this already. All right, so this slide is very important. So make sure to remember that M2 equals to M1 plus money market, certificate deposit, and also other checkable deposit. And then M1 is your cash plus checking account and plus your, oh, that's a typo here. So this should be traveler check, not a saving deposit. Okay, that's a typo at the end. So M2 is your currency plus your checkable deposit plus traveler check. So guys, this slide here is very important. There will be some questions on the quiz over the formula and math question for the math portion of this chapter. All right, so also knows the debit card and credit card. So debit card there, whenever, if you know the difference, that means you're pretty good. So debit card is whenever you swipe it, that money coming out of the account directly. That's a debit card. So debit card is linked to your bank account. Credit card, however, is a borrow money. That whenever you swipe the card, the credit card company will pay for the transaction first, and then by the end of the month, you promise to pay the money back to credit card, right? So debit card is part of our money because it's linked to your bank account. Your credit card is not part of money because that's a borrow money. That's not a real money. It's not there yet. And next is smart card. So think about, and this is like a very old days, for anybody who is going to a university that has a cafeteria, you might have a prepaid card for your dining options, right? So every time you go to eat in the cafeteria, you swipe it. That's a smart card, right? So it's a system that you can store money on it, and then you can use it to make purchases. Okay, so most money are in the bank account, right? So in almost every single country, that we have more cash than money, because most of the money in the system, they're all just a number in the computer system, right? So think about it, right? So let's suppose if I go to the bank, deposit $10. And then tomorrow, you go to the bank, withdraw $10. So once that happens, how much money do we have in the entire system? Do we have $10 or do you have 20? I would say we have 20 because you actually have $10 in your hand, and I believe I still have $10 in my saving or checking account, right? So at that time, then how much money we have? We have $20 while there's only $10 cash in the system. That's because the other $10 is just a number in the computer system, right? So that's why we have more money than cash. So a payment system that helps the economy exchange goods and services for money or other financial assets. So think about your debit card, credit cards, your checking account. Those will be your all the payment system we have. And then also knows the transaction cost. So this is the cost associated with finding a lender or borrower for this money. The most commonly known or commonly used transaction cost, that every time you guys go swipe a credit card, there's a cost associated with it that you don't pay for it, but most likely that the business owner pay for it. And that's why at some places, if you go online to shop, they will charge you a transaction fee. That transaction fee is not being charged by the company. It's actually being charged by the credit card company on that company, right? So that's a transaction cost. So what the banks will do, banks will bring the savers, so people who are saving money, and then the borrower come together. We can also say that the bankers are the smartest people in the economy, because this is what the bankers will do. The bankers will take money away from savers, give it to the borrower at a higher interest rate. And that difference in interest rate, that's the bank's profit. Right? So if you go, let's say you go to Bank of America today. You go to Bank of America, you want to open a saving account, and they might pay you, let's say 2% interest rate. Now tomorrow you go to the same bank and say, hey, Bank of America, I want to borrow money from you. And they will charge you, 5%, 7%, 8%. So that extra interest rate they charge, that's the bank's profit. And when the banks lend the money out, the banks are not lending out their own money. They're lending out the savers' money, right? So it's really taking money away from the public, give it back to the public at a higher interest rate. And that's how the banks make money. Now, banks also, they do have a transaction cost as well. but they have some of the lower transaction costs compared to other financial intermediaries. So compared to credit card companies, your local banks has a lower cost. So a financial intermediary, so this will be just the middleman between the people who save money and then people who borrow money. That we all the banks are financial intermediaries. They're standing in the middle to bridge the gap between the borrower and saver. And we also call the banks depository institutions. But there are also other institutions, or there are also other financial intermediaries that are not depository institutions. So think about your investment banks. Goldman Sachs, right? Goldman Sachs is not a depository institution, but Goldman Sachs also connects between your savers and borrowers. All right, so like what we mentioned, so this is how the banks make money. So banks would take money from depositors, so savers would deposit money to the banks, and then bank in return would pay them an interest payment, right? So this might be a 2% interest paid to the savers. And then they're gonna take the money and then lend it out, so lend the money out, so as a loan to borrower, and borrower will pay the money back, and they might be paying back a 6% interest payment. And that 4% difference, that's the bank's profit, right? So that's how the banks make money. All right, so also know what's a bank's balance sheet. So in this chapter, we're going to talk briefly about some very basic accounting concept. So for anybody here who's want to major in business, this will be a preview for your accounting classes. So one of the most important document in any company is called a balance sheet. So balance sheet obviously is balanced, right? So but it's balanced between what? It's a balance between your asset and liability. So the most important equation in accounting is A equals to L plus E. So A is called asset. So asset, anything has a value in the company. L is liability. That's anything the company borrowed. And then E is called equity. That's whatever the value the owner control. But in this chapter, we're going to call this net worth. They mean the same thing. So net worth is also the equity. That's how much value the owner has under control. That's called the equity. So so let's suppose, let's say I open a company. And then right now in my company, we have room full of table and chairs. And let's suppose all the table I borrow from school, right? So that will be my liability. All the chairs, that's my chair. So that's going to be my equity and then net worth. And then all the table and chair together, that's my company's asset, right? So for everything the company has, they either borrow from somebody else or is contributed by the owner. So that's a total asset. And lastly, your bank's capital, that's your bank's net worth. That's how much the owner has in control. All right, so this is what a balance sheet looks like. Notice that we have a little line in the middle. So the reason why, again, the reason it's called balanced, because with everything on the left must equal to everything on the right, right? So you have loans, government security, and then reserve that total up to $11 million. And then for the right-hand side, we have our deposit, our net worth. They also total to $11 million. So these two sides must equal to each other, and that's called a balance sheet. But for now, we're going to call this a T account. So when they put it in this form, it's called a T account. That means everything on the left under asset is equal to everything on the right. That's a liability plus net worth. Also know what's a reserve. So every time you heard the word reserve in the bank, it just means cash in the bank, right? So how much cash that's currently the bank has, that's called a reserve. For every bank in America, our Federal Reserve, remember our central bank in America, they also conduct banking regulation. So for every bank in America, they have to follow what is called a required reserve ratio. So the Federal Reserve actually set a limit on how much cash the bank must hold on to at all time. So that's called a required reserve ratio. So this word reserve, you're going to hear this very often. Every time you hear it, this means cash in the bank. So required reserve ratio, that means percentage of the required cash that's in the bank. And also know that the net worth in the bank has to be positive for bank to be financially sound. If your net worth become negative, that means this bank is insolvent. That this bank is pretty much one step away from bankruptcy whenever your net worth is negative, right? So that's why all the banking regulators in the Federal Reserve is looking at this net worth very carefully. Every time it falls down, that's indicating the bank is in trouble. And if you guys are interested, look up something called a Silicon Valley Bank that went bankrupt earlier 2023. So that happened because the Silicon Valley Bank, their net worth was at risk. That was almost becoming negative, and they were having trouble getting additional net worth into the bank. Okay, so we want this number to be as high as possible. All right, so some potential problem for the bank. So first, if the bank has a very high rate of default, that's bad. So default means the people who borrow money are unable to pay the money back. So imagine if I go to Bank of America and say, hey, Bank of America, I want to borrow $30 million to buy the most expensive home in Houston. Well, if Bank of America give me $30 million and I cannot pay the money back, that is called default. That when the loan goes to default, that the banks might be at risk of losing money from the loan, right? So if the bank has a lot of default loan, then this bank is in trouble. And second, there might be a time mismatch between people who deposit money and also people who withdraw, or people who borrow money. Because for people who save money, they can get the money out right away. But for people who borrow the money, they tend to pay the money back in a long time, right? So again, imagine if I go to the bank, deposit $10, and I say, hey, Bank of America, this is yours, but I might get the money out anytime I want. That's okay. And then you go to the bank, you borrow $10. And say, hey, Bank of America, I'm going to borrow $10 from you, but I'm going to pay your money back to you this time next year. So now we got a problem, because at this time, that bank's balance sheet, the T account, is showing zero reserve because you borrow all the money. So if I go to the bank, get the money out, they cannot give it to me anymore because you have the money. So that bank is also called insolvent, and that's called an asset liability time mismatch. And that's why the banks, they tend to want to diversify, so make deposit, make investment into different entities, different categories, just so if that one area goes down, they still have other area to pay the money back. So many banks tend to have investment into real estate market, mortgage market, and also investment into our government security. So remember that $32 trillion of our government debt right now, right? If you go to a website called usdebtclock.org, it will show you how much our government debt is, right? So that's $32 trillion. A lot of money is coming from internally, that your U.S. companies, investors lend the money to our government, and big part of that money is coming from our banks, because the U.S. government always pay the money back to the investors. So that investment seems like a very secure. So for a lot of banks, they tend to deposit the money within our U.S. federal government security or bond or reserves. Okay, so next I'll show you how money is being created in the economy. So whenever we need more money in the economy, we can just let the Federal Reserve print more money. That's one way. We don't do that anymore. The other way is to allow the banks offer more lending. That whenever the banks lend the money out, that lending process is called a money creation. Now remember the example we used at the beginning of the chapter. We said, hey, if I deposit $10 and then if you borrow $10, we now have $20 in the economy, right? That because you borrowed money, that process is creating more money. So let's see how this works, right? So let's suppose we have a bank's balance sheet here. Let's suppose we have our first person who decide to, so this bank right now has a total reserve of $10 million. And then right now that reserve is all in the hand of deposit. So that money is safe in the bank. Now let's suppose we have a business coming, and then business want to borrow $9 million. Now when they borrow $9 million, so this balance sheet will become $1 million is still as part of reserve, so still cash in the bank. And then the other $9 million is now given to Hank's Auto Supply. But we still have a total supply of $10 million. All right, so let's see what happens next. Now, let's suppose your Hank's Auto Supply decide to, instead of spend the money, but we decide to deposit the money with another bank. And that deposit, so that $9 million deposit go to the other bank. And then in the other bank, so in the First National Bank's balance sheet, we now have another $9 million reserve, so cash, and then deposit of $9 million. Now remember from the previous bank, that was what, the Singleton Bank, right? So at the time we had a $10 million, and now we have additional $9 million from the First National balance sheet, and now this is becoming $19 million total cash. But what if the First National Bank also lend the money out? So again, we also offer another lending for $8.1 million on top of our 10 and a 9. So this money is getting more and more and more every time when the banks lend the money out. So again, money creation is not just by printing out more cash. Money creation is whenever the banks lend the money out. So that lending money out is creating more money in the economy. So this process is called a money multiplier. And a money multiplier, the formula is very simple. It just says 1 divided by the reserve requirement. So this is a percentage that is set up by our Federal Reserve on each individual bank. It says, hey, if you're doing very, very good job, you might have a lower required reserve ratio. So let's say if you're Bank of America, you're very secure. Gonna say Bank of America, you only need to have, let's say, 10% of cash in the bank. But if you're a bank that's very, very risky, then our Federal Reserve might say, hey, you're very, very bad. We're gonna make sure you have at least 35% of cash in the bank. Now, by having a lower reserve ratio, the bank can offer more lending. That also means higher profit. But a higher required reserve ratio, that this higher cash in the bank is not making any profit for the bank. So a higher reserve ratio, banks has a lower profit. Okay, so we have an example here. So if the reserve requirement is 10%, the bank's excess reserve is $9 million. How much would it change our M1 money supply? So first, we're gonna find out what's our money multiplier, because MM stands for money multiplier. So that equals to 1 over 10%, and that's gonna give you 10. And then you're changing the money supply. That's gonna be your money multiplier times this excess reserve on $9 million. So that's going to be 10 times $9 million, and this equal to a total of $90 million. So if the bank decide to lend the money out, so lend out the $9 million, that this $9 million can create a total of $90 million of total additional money in the economy. And that's called a money multiplier. So the amount of money in the economy is really closely linked to how much our lending, our credit is in the economy. So the more money we have in the system, the more money will be available for lending. So easier for people to borrow money, and vice versa. If there are less money available in the system, that will be more difficult for people to borrow money. And then all the money in the system are linked to our required reserve money multiplier phenomenon, that whenever the money is lent out, they'll be creating additional money in the economy. Now, for banks, some banks will choose to have just enough to cover the required reserve. Other banks might choose to have a little more than what's the requirement. And there might be two reasons behind it. So one, it might be what the government regulation is. For two, might be what is the condition for the economy. That if the economy is doing pretty bad, so imagine the economy going through a recession, then some of the banks might want to hold on to a little extra cash on hand, just in case if they're having trouble in the default market. And also your Federal Reserve might choose to either increase or decrease the required reserve and try to change our total amount of money in the economy. Okay. All right, guys. That's it for this chapter. Have any question, let me know, and I'll see you guys for next chapter. All right. Bye-bye.